Good morning. Good morning. Once again, this is James from the Wall Street Minute, standing right in front of the New York Stock Exchange, and today we're going to talk about that kind of messy market we saw yesterday. It started off with Moody's downgrading about 10 banks, which fed further fears of lack of confidence in the banking system. There's another issue going on too that I think a lot of people aren't talking about. A lot of non-bank companies, like tech companies, are now getting involved in the banking sector, like PayPal, and I think this is putting added pressure on the banking sector. What do I think? I think if banks are reacting to higher interest rates, in the short term it's going to be difficult because they have to adjust. In the long term, you're going to have a more secure yield curve. In other words, you'll have lower short-term rates and higher long-term rates. Banks borrow short and lend long, and they make money on the spread. That's how they did it in the old days when you used to have a yield curve before we had this zero interest rate policy. I think in the long run it's better. In the long run, when you have interest rates like 5%, that's kind of the norm over the last 100 years. I've talked about this before. It's called the normalization of interest rates. And the reality is a zero rate environment would let one believe that there is zero risk in the environment, which is absurd. Anyway, this is James once again from the Wall Street Minute. Say hello, leave comments, and of course, subscribe to these videos.